In the spring of 1923, a loaf of bread in Berlin cost 474 marks. By November of that same year, the same loaf cost 200 billion marks. Workers were paid twice a day so they could rush to spend their wages before the money lost half its value by sundown. Women carried cash in laundry baskets and wheelbarrows. Children built castles out of bundled banknotes because the paper was worth less than wooden blocks. A lifetime of savings, the kind a careful man might build over 40 years of disciplined work, could vanish between breakfast and dinner. Now here is the part most people never stop to ask. Who decided to print all that money? It was not a foreign army. It was not a natural disaster. It was a small group of men sitting in a marble building in the center of Berlin, signing documents, pressing buttons on printing presses, and convincing themselves they were saving the country. They were the central bank, and what happened in Germany in 1923 was not an accident. It was the predictable result of decisions that any central bank anywhere in the world can make at any time. The terrifying truth is that the institution most people trust to protect the value of their money is the same institution with the unique power to destroy it. And history shows that when central banks decide to destroy an economy, whether by mistake, by panic, or by political pressure, it happens far faster than anyone expects. To understand how a central bank can dismantle an entire economy, you first have to understand what a central bank actually is. Because most people have only the vaguest idea. A central bank is not a normal bank. You cannot walk in and open a checking account. It does not lend money to small businesses or hand out mortgages to families. A central bank is something stranger and more powerful than that. It is the only institution in a country that has the legal authority to create new money out of thin air. Not earn it, not borrow it, create it. With a few keystrokes on a computer, a central banker can add $1 billion to the banking system that did not exist a moment before. No gold was mined, no goods were produced, no labor was performed. The money simply appears, and then it flows out into the wider economy, mixing with the money you earn through years of work. That power, the power to print, is the single most consequential power in modern finance, and it is held by a tiny number of unelected officials. They set interest rates, which determines how expensive it is for everyone else to borrow. They buy and sell government bonds, which determines how much the government can spend without raising taxes. They decide which banks live and which banks die during a crisis, and in theory, all of this is done in the name of stability. In practice, the same tools that can stabilize an economy can also annihilate it. The first and most common way a central bank destroys an economy is the one we already glimpsed in Berlin. It is called monetary debasement, and it works through a mechanism so simple a child could understand it, yet so politically tempting that governments throughout history have walked into it again and again. When a government spends more money than it collects in taxes, it has to cover the gap somehow. It can borrow from the public by selling bonds. It can raise taxes, which voters hate. Or it can quietly ask the central bank to buy those bonds with newly printed money. That third option feels painless. No new taxes. No angry voters. The bills get paid. But every new unit of currency that enters circulation without a corresponding increase in real goods and services dilutes every existing unit. Imagine a small town with 100 loaves of bread and $100 in circulation. Each loaf costs $1. Now imagine the central bank prints another $100 and hands it to the government. Suddenly, there are $200 chasing 100 loaves. The price of bread doubles. Nothing about the bread changed. Nothing about the wheat changed. The only thing that changed was the quantity of money. This is inflation in its purest form, and it is not a mysterious force of nature. It is a policy choice made by specific people, in specific rooms, with specific signatures. What makes monetary debasement so dangerous is not the slow version, the 2 or 3% inflation that gently erodes savings over decades. The dangerous version is the runaway version, the version that begins as a controlled experiment and ends with citizens burning banknotes to stay warm. Hyperinflation does not announce itself. It creeps in quietly, then accelerates with terrifying speed. In Weimar Germany, the central bank began printing aggressively in 1921 to pay war reparations and cover government deficits. For the first year, prices rose noticeably, but not catastrophically. People grumbled. Then in 1922, the curve bent upward. By the middle of 1923, prices were doubling every few days. By the autumn, they were doubling every few hours. The same psychological dynamic plays out every time. Citizens see prices rising and rush to spend their money before it loses more value. That rush to spend pushes prices higher still, which triggers more printing to keep wages and pensions from collapsing, which pushes prices higher again. It is a feedback loop, and once it starts spinning fast enough, no central banker on earth has ever managed to stop it without inflicting a severe recession, mass unemployment, and the complete destruction of the existing currency. Zimbabwe lived through it in 2008. Venezuela lived through it after 2016. Argentina has lived through it more times than its own historians can count. And every single case began the same way, with a central bank that thought it could print just a little bit more. But monetary debasement is only the first weapon in the arsenal. The second is far subtler and far more common in modern wealthy nations. It is the manipulation of interest rates. When a central bank lowers interest rates, borrowing becomes cheap. Cheap borrowing feels wonderful in the short term. Families take out mortgages they could not previously afford. Businesses expand into new markets. Stock prices soar because investors can borrow money at almost no cost and pour it into financial assets. Politicians celebrate the rising numbers and take credit for the boom. The problem is that artificially low interest rates do not create real wealth. They create the illusion of wealth by pulling future consumption into the present. People borrow against tomorrow to buy things today. Companies invest in projects that only make sense if money stays cheap forever. Asset prices detach from the underlying earnings that are supposed to support them. A house that should cost 3 times the local median income starts costing 8 times. A company that has never made a profit gets valued at $50 billion. None of this looks like a crisis while it is happening. It looks like prosperity. The pain comes later, when the central bank finally has to raise rates to fight the inflation that the cheap money inevitably produced. And when those rates rise, every fragile structure built on the assumption of permanent cheap credit begins to crack at the same time. Consider what happened in Japan in the late 1980s. The Bank of Japan, worried about a strong yen hurting exporters, slashed interest rates and flooded the banking system with cheap credit. Money poured into real estate and stocks. At the peak, the land beneath the Imperial Palace in Tokyo was reportedly worth more than all the real estate in the state of California. The Nikkei stock index nearly quadrupled in 5 years. Japanese banks lent recklessly because they were convinced the boom would never end. Then, in 1990, the central bank reversed course and raised rates to cool things down. The bubble did not deflate gently. It collapsed. The stock market lost more than half its value within 2 years. Real estate prices fell for the next 20 years. Japan entered a stagnation so prolonged and so deep that economists invented a new phrase for it, the lost decade, which then became the lost 2 decades, and is now creeping toward the lost 3 decades. An entire generation of Japanese workers grew up in an economy that simply refused to grow. None of this was inevitable. It was the direct consequence of a central bank that first inflated a bubble and then popped it, all in the name of managing the economy. The lesson is not that central bankers are stupid. Many of them are brilliant. The lesson is that the tools they wield are too crude for the task they have been assigned, and the side effects often dwarf the intended benefits. The third way a central bank can destroy an economy is through what is politely called credit allocation, and what less politely should be called picking winners and losers. In a true free market, capital flows toward the businesses and projects that produce the most value, because those are the ones that can pay back loans with interest. Bad businesses fail. Good businesses thrive. The system is harsh, but it is honest. When a central bank gets involved in deciding who receives credit and on what terms, that honest signal disappears. Suddenly, capital flows not toward the most productive uses, but toward the most politically connected ones. Banks that should have failed get bailed out because they are deemed too important to collapse. Industries that cannot compete get cheap loans because they employ voters in important districts. Speculators who took reckless bets get rescued because their failure would embarrass the people who allowed the bets in the first place. Over time, the entire structure of the economy bends around the question of who has access to the central bank's favor, rather than who is actually producing things people want. Productivity slows. Innovation stagnates. Resources get locked into zombie companies that should have died years ago, but are kept alive on a drip feed of subsidized credit. The economy still looks alive on the surface, but underneath, the muscles are atrophying. Nowhere is this distortion more visible than in the so-called too big to fail doctrine that emerged from the 2008 financial crisis. When the crisis hit, central banks around the world faced a choice. They could let the largest banks, the ones whose reckless bets had triggered the collapse, suffer the consequences of their decisions. Or they could rescue them with trillions of newly created dollars and euros and pounds. They chose rescue. The official justification was that letting the banks fail would have caused a depression. Perhaps that was true. But the long-term consequence was a banking system that learned a deadly lesson, that no matter how reckless the bet, the central bank would be there to absorb the losses. Profits stayed private. Losses got socialized. And the very institutions whose failure had nearly destroyed the global economy emerged from the crisis larger, more concentrated, and more powerful than before. Meanwhile, ordinary savers who had done nothing wrong watched the interest on their savings accounts fall to almost zero, where it would remain for more than a decade. The message was unmistakable. The central bank exists to protect the system, and the system means the largest financial institutions, not the people who deposit their paychecks. The fourth way a central bank can destroy an economy is the one almost no one talks about, because it sounds too abstract to be dangerous. It is the destruction of price signals. Prices in a healthy economy are not arbitrary numbers. They are information. The price of oil tells producers how much to drill and consumers how much to conserve. The price of labor tells workers which skills are in demand and employers which roles they can afford to fill. The price of money itself, the interest rate, tells savers how much to save and borrowers how much to borrow. When all of these prices are allowed to move freely, the economy coordinates billions of independent decisions without anyone in charge. It is the most remarkable information system humanity has ever built. When a central bank intervenes heavily and persistently in the price of money, it scrambles all of those signals at once. Borrowers cannot tell whether a loan is genuinely affordable or only artificially affordable. Savers cannot tell whether their savings are genuinely growing or only nominally growing while inflation eats them alive. Businesses cannot tell whether their projects are genuinely profitable or only profitable because credit is being subsidized. The economy starts making decisions based on false information, and false information at scale always leads to misallocation, and misallocation at scale always leads to crisis. The crisis may take 5 years to arrive, or 15, or 25, but it always arrives. What makes this fourth weapon so insidious is that it operates invisibly. There is no moment of obvious failure. There is no single price you can point to and say, that one is wrong. The damage is spread across millions of small decisions, each one slightly distorted, each one slightly off, accumulating quietly over years until the entire economic structure is built on a foundation that no one fully understands and no one can fully repair. By the time the consequences become visible, the original decisions that caused them are buried under a decade of subsequent decisions, all of which depended on the original distortion remaining in place. Trying to unwind it without triggering a collapse becomes nearly impossible. Central bankers find themselves trapped in a corner of their own making. They cannot raise rates without crashing the asset markets they spent years inflating. They cannot lower rates further because rates are already near zero. They cannot stop printing because the system has become addicted to the constant flow of new money. Every option leads to pain. The only question is, who absorbs the pain and how quickly it arrives? If what you are hearing right now is starting to change the way you look at the financial system, do me one small favor before we continue. Tap the subscribe button. This channel exists to expose the hidden machinery of money, the things the official narratives gloss over. And the more people who follow along, the harder it becomes for those stories to stay buried. Subscribing costs you nothing and takes 1 second. It tells the algorithm to bring this kind of investigation to more people who deserve to see it. Now let us get back to the story, because what comes next is the part that should genuinely keep you awake at night. Here is something that almost no one outside of professional economic circles fully appreciates. When a central bank destroys an economy, the destruction does not happen on the timeline most people imagine. We tend to think of economic collapse as a slow grinding process, the kind of thing you would see coming for years and have time to prepare for. The historical record tells a very different story. Once the underlying conditions are in place, the actual collapse can unfold in a matter of weeks. The Weimar hyperinflation went from troubling to catastrophic in less than 18 months. The Zimbabwean dollar lost 99.9% of its value in a single year. The Venezuelan bolivar became effectively worthless within 24 months of the worst printing decisions. The pattern is always the same. Years of accumulating distortions create a system that looks stable on the surface, but is brittle underneath. Then some trigger arrives: a war, a political shock, a loss of confidence, a bank failure, and the brittle system shatters. The speed of the shattering catches everyone off guard, including the central bankers who built the system in the first place. The reason these collapses move so quickly is that modern economies depend on confidence, and confidence is not a slow-moving variable. Confidence can hold steady for years and then evaporate in a single afternoon. Consider what happened in Argentina in 2001. For most of the 1990s, Argentina was held up as a shining example of monetary discipline. The central bank had pegged the peso to the dollar at a 1-to-1 ratio, and inflation, which had reached thousands of percent in the late 1980s, had been crushed back to almost nothing. Foreign investment poured in. Buenos Aires became one of the most expensive cities in Latin America. Then, in late 2001, doubts began to surface about whether the peg could be maintained. Within weeks, citizens started withdrawing their savings from banks. The government imposed limits on withdrawals, which only confirmed everyone's worst fears. Riots broke out. The president fled the presidential palace by helicopter. The peg collapsed. The peso lost roughly 70% of its value within months. Savings that had been carefully accumulated in dollars, then forcibly converted into pesos at unfavorable rates, were effectively wiped out. None of this took years. The decisive collapse took weeks. The years had been spent building the conditions that made the collapse possible. Another reason the collapse is so fast is the role of the digital banking system. In an earlier era when money meant physical coins and notes, a bank run took time. Depositors had to physically travel to the branch, stand in line, and walk away with cash. There was friction in the system, and friction bought time for authorities to respond. In the modern world, that friction is gone. A depositor can move their entire life savings out of one bank and into another with a few taps on a phone screen. When confidence in a bank or a currency starts to crack, the outflow can reach billions of dollars per hour. Silicon Valley Bank, in early 2023, lost $42 billion in deposits in a single day, with another $100 billion queued to leave the next morning before regulators stepped in. The bank had been considered sound by every conventional measure just weeks earlier. The same speed that makes modern banking convenient makes it terrifyingly fragile. And that fragility is only partially the fault of the banks themselves. It is also a direct consequence of central bank policies that push those banks into riskier positions while convincing them that risk no longer existed. By now you may be wondering why, given all of this, central banks continue to exist in their current form? The answer is partly historical inertia, partly political convenience, and partly a genuine belief among the people who run these institutions that the alternative is worse. Central banks were originally created to solve real problems. They were meant to prevent the chaotic boom and bust cycles of the 19th century, when private banks routinely failed and dragged the economy down with them. They were meant to provide a lender of last resort in moments of panic, so that solvent institutions would not be killed by temporary liquidity shortages. They were meant, above all, to protect the stability of the currency and the integrity of the financial system. For long stretches of history, they did exactly that. The problem is that the mandate has expanded relentlessly over the decades. What began as a narrow technical role evolved into a sprawling responsibility for managing the entire economy. Central banks today are expected to fight inflation, promote full employment, regulate the banking system, maintain financial stability, support government borrowing, respond to climate change, address inequality, and somehow do all of this without making mistakes. It is an impossible mandate. And impossible mandates produce impossible policies. And impossible policies eventually produce the kinds of collapses we have been describing. So, what should an ordinary person, someone who is not a banker, and not an economist, and not a politician, take away from all of this? The first lesson is that the value of money is not a law of nature. It is a political artifact sustained by the decisions of a small number of people, and those decisions can change at any time. Anyone who keeps the entirety of their wealth in a single currency, trusting indefinitely in the wisdom of the people managing that currency, is taking a much larger risk than they realize. Throughout history, the people who survived monetary collapses with their wealth intact were the ones who held a portion of their savings in things that could not be printed: land, tools, stored goods, foreign currencies, gold and silver. The specific instruments matter less than the principle, which is that diversification across different forms of value is the only meaningful protection against the failure of any single form. The second lesson is to pay attention to what central banks are actually doing rather than what they are saying. Central bankers are trained communicators. Their words are designed to soothe and reassure. Their actions, the actual flows of credit and money, tell a more honest story. And that story is available to anyone willing to read it. The third lesson is the hardest. It is to accept that the system is more fragile than it appears, that the people in charge are more uncertain than they seem, and that the next collapse, when it comes, will arrive faster than anyone is prepared for. The story of central banks is not a story of villains. It is a story of human beings, granted enormous power, operating in a system that almost guarantees they will eventually misuse it, no matter how good their intentions. Every hyperinflation in history was accompanied by official assurances that everything was under control, right up until the moment it obviously was not. Every banking crisis was preceded by regulators insisting the system was sound. Every currency collapse was foreshadowed by central bankers who genuinely believed they had the situation in hand. The pattern repeats because the underlying structure of the institution remains the same. A small group of people, with the legal monopoly on creating money, accountable to no voters, operating under enormous political pressure, making decisions whose consequences will only become visible years after they themselves have retired. That structure produces predictable outcomes, and the outcomes are not gentle. If you take only one thing from everything you have heard tonight, let it be this: the value of the money in your pocket, the savings in your account, the price of the home you live in, the cost of the food you eat, none of it is fixed. All of it depends on the continued competence and restraint of an institution that history shows is rarely competent for very long and almost never restrained for as long as it should be. Understanding this will not protect you completely, but it will give you something most people never have, which is a clear view of the ground you are standing on. And once you see how thin that ground actually is, you can no longer be blindsided when it begins to shift. If this kind of investigation into the hidden architecture of money is the kind of thing that interests you, the next video on this channel goes even deeper into the secret history of how the modern banking system was actually designed and who was really in the room when it was built. The story is stranger than you have been told, and you can watch it next, right here, right here.